Trip here at financiallypossible.com, and today I'm going to talk about bonds. Bonds are sort of an underloved asset category by the younger generation, and I know a lot of people have this tendency to favor stocks over bonds, particularly in the early retirement community. A lot of them go 100% equities or 100% stocks. But in 2009, I started investing in bonds outside of my 401k, and I've been investing in stocks since 2001. So even I had this tendency to favor stocks over bonds. But in the latter months of 2009, the stock market had just crashed and was recovering strongly, and the share prices on the stocks had gone for a roller coaster ride. I had witnessed a lot of turmoil, and I was interested in trying to find a safer, more stable place for my money to invest and get nice, consistent returns without quite as much volatility. My grandfather taught me that I could invest in municipal bonds and get tax-free returns and not have it be nearly as volatile as owning individual stocks. He actually buys individual municipal bonds. He goes into a newspaper and finds information about what they're yielding and how they're priced relative to par value. I've never reached quite that level of sophistication, but I did start investing in municipal bond funds in late 2009, and I'm so happy that I have. In hindsight, I could have invested all my money in stocks back then, and I'm sure I'd be even wealthier today if I had done that and hadn't started investing in bonds. But bonds, they're not about shooting the moon and getting great returns. They're about having a certain anchor to your portfolio, something that allows you to sleep better at night, so that you're not taken for this wild ride that the stock market gives you. Currently, I'm allocating 70% of my investable assets into stocks and 30% in bonds. It was a lower percentage back in 2009. I think I was at 15 to 20% bonds. But I was really just starting to educate myself on bonds at that time. I'm so glad that my grandfather started teaching me, and I'm here to help teach you about bonds. Over the long term, according to this research from 1926, stocks have returned an average of 10% per year, whereas bonds have returned anywhere from 5 to 6% per year. So a lot of people see this research and they're like, why invest in bonds at all? Well, it's not about improving your returns. It's about reducing your volatility. So mixing some bonds with stocks can help reduce that volatility, and you still will get good returns over the long term on your investments. This site, ETFcom, shows a list of various tickers that are for broad-based bond funds, bond index funds. And I did a search within it for U.S. broad-based market bonds ETF. And it told me this list of tickers. You can see the ticker symbols here. You can see the names of the funds, the expense ratios. This is something so vital for every investor to always pay attention to. What is the expense ratio? What are the fees for the investment? Are there any redemption fees or front load fees or back load or back end fees if you go to sell? Ask all these questions before you buy. Find out all that information. Know what it is you're getting into. And then lastly, it shows a segment which just tells you what type of bonds it invests in. Like this first one shows it's a broad market investment grade bonds for the entire US. Whereas some of these others, they might say short term or intermediate term. And I'll get into more about what that means in a bit. But let's go over here to this tax tab. This is so important. You can see that there are maximum long-term capital gains rates and maximum short-term capital gains rates that these funds target. And they won't generate more than this amount in capital gains, long and short term. But these are nearly 40% short-term capital gains rate, which means owning these funds could affect your taxes quite a bit. So if you're looking at adding bonds funds to your portfolios, the best place to do that is in your tax-advantaged accounts, your 401ks, your traditional IRAs, your Roth IRAs. This way, you don't have to pay taxes on these short-term capital gains. I personally don't own any of these bond funds within my taxable account. The only types of bonds that I choose to place in my taxable account are municipal bonds, simply because they are tax-free. This fund, bond, BND, is a Vanguard Total Bond Market ETF. This is what I was talking about with volatility. Back in the beginning of 2008, the bond fund ETF peaked at about $78.35. When the market crashed due to the financial crisis, it was down at $73.13. That's not even a 10% loss from peak to trough. Whereas the S&P 500 during that time, I think it lost around 55%, more than half its value. So if you own some bonds as well, you weren't hurt nearly as bad by the financial crisis. And this is exactly why I started adding bonds to my portfolio at the end of 2009. Here is a municipal bond fund called PZA. It is long-term bonds. And you can see this one was a little more affected by the financial crisis. It peaked at 25 roughly, and its trough was down at $20.74. Not even quite a 20% loss, but still nowhere near as bad as what stock funds lost during the financial crisis. You can see this one yields 3.3%, tax-free. If you live in a state that has a state income tax, though, you will pay state income taxes on your yield. Now, you can see in this right panel what some of the top 10 holdings are, and it'll list where the bond is located, like this one's in Chicago, or this one's in Miami, this one's in California. It tells you what percentage of this PZA bond fund is comprised of these various bonds, and it tells you what the yield is for these. So Chicago is yielding at 5% and Miami at 5%. You can find out this information as well from prospectuses, but not always can you find out quite as much information. So here's the prospectus for PZA, and it lists the credit ratings. So one key component of each individual bond is a grade that it receives from the rating agencies. And this top line here, AAA, is the highest grade. The next line is AA, and then A, and then BBB. This is the bottommost grade that's still considered investment grade. These lower ratings here, like BB and B, the default rates start to increase pretty rapidly, and that means you're more at risk of losing money on those individual bonds. So these lower rated bonds, they're sometimes called high yield or junk. They're not considered investment grade. They will yield higher, but they're also higher risk. The bond market is very, very logical. So you want to take on more risk, you're going to get paid for it, but you also risk losing the money that you put in when you start going for those riskier bonds. This here shows the same top 10 holdings, and the coupon is just a term that is used in the bond market for yield. Over here, it shows the state allocation. So the heaviest states that this particular bond fund represents are New York and California, which are two of the largest states in terms of the U.S. economy, and that's not surprising. Illinois, I know, is one of the riskier states in terms of municipal bonds. The city of Chicago is having budget problems, so it's good that I see a low percentage for Illinois there. Maturity is definitely another thing to consider when you're looking at bonds and bond funds. How long is the maturity on the various bonds? Anything below 5 years is considered a short-term bond and is going to be less sensitive to something called interest rate risk. Interest rate risk means when interest rates rise, it's going to hurt bond prices because new bonds that can be issued are better deals to investors than old bonds that were issued in the past. So the old bonds suddenly become worth a bit less. Bonds that have shorter maturities don't get hurt as bad when interest rates rise. Medium maturity or intermediate term is 5 to 10 years. And long term is 10 or more. So just like I said, this fund, PZA, it is a long-term municipal bond fund. You can see pretty much all of its holdings are 10 or more years. Another type of bond is a corporate bond. These are taxable bonds, and this particular Vanguard index fund is called the Vanguard Intermediate Term Corporate Bond ETF. It invests in basically company debt. You can see here it's got a nice low expense ratio, 0.07. Down here it shows the grades for the various bonds, and you can see the lowest rated is the first level of B, which is still investment grade. So this one only invests in investment grade bonds. It tells you the average duration is 6.5 years. The average effective maturity is 7.5 years. So this is definitely right in that intermediate range of 5 to 10 years. If I want to see what are some of its top 10 holdings, I can look over here at this tab and it shows, okay, Anheuser-Busch, that's Budweiser. It's 0.75% is corporate debt from Budweiser, basically. And it's yielding 3.65. And then here's Verizon yielding 5.15 and Apple 2.4. So it's just a variety of different companies with different yields. Here's a Budweiser again, but a different yield. So these were two different bonds, probably issued at different times, so they received different yields. Another type of bond is government bonds. They tend to be U.S. government bonds. They tend to be considered the safest, and they also yield the least amount. So they'll be the least volatile in your bond portfolio, but they're not going to generate a ton of income for you either. One type of U.S. government bonds are called TIPS, Treasury Inflation Protected Securities. So when inflation starts to become a bigger factor in the U.S., you are basically insured against that event. So when the interest rates start rising and inflation is expected to pick up, the fund starts to return a bit better. You can buy non-inflation protected U.S. bonds as well. So the various types of bonds are municipal bonds, which are tax-free, U.S. government bonds, corporate bonds, and then high-yield bonds, which would be anything that's non-investment grade. And those could be from corporations or from foreign governments. International bonds is another area of bonds that I personally don't like to go into. I choose not to invest very much money in international bonds. I like to keep my money here in the U.S. when it comes to bonds. I've covered the grades, the investment grades, the maturity dates. These are all the types of things that you really need to know to start looking and analyzing different types of bond funds. So thank you for sticking with me, and I hope you have a grasp on how to choose your bond funds now. Please feel free to ask any questions you want in the comments section. Subscribe to my channel, please. reach out to me. I'm happy to hear from you. Share with anybody that you think might want to learn about bonds, and have a great evening. This was Trip at Financially Possible.